Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. And today, Options Guide TV is going to be all about education. This is a pre-recorded show. We're going to look at a long call spread and a long put spread. And we're going to talk about how time premium is affected in these spreads. Now, we are in the heart of earnings season. We're going to be looking at some ways to speculate on earnings around an earnings announcement. So, for example, if you're thinking about long call spreads or long put spreads, and also on the other side of the coin, a short call spread and a short put spread, it's really good to understand how time affects these strategies, because that's what spreads are all about. You're buying an option contract that time decay hurts, and you're selling an option contract that time decay helps. So we're going to start by going to the options playbook and just introduce a long call spread as our first example, and then we'll look at a long put spread as the next example. So let's start by running to the options playbook. And here we have the strategy of a long call spread. So quite simply, here's the profit and loss graph at expiration. It looks much different prior to the expiration date, but here's the setup. For example, if I have an underlying stock, and let's say that stock is trading somewhere between strike A and strike B, so the stock's somewhere within this range, I might think about doing a long call spread. And that means that I'm going to buy strike A. I'm going to buy the more expensive option contract. And then at the same time, I'm going to sell strike B. Both of them will usually have the same expiration. And if I do this at expiration, that's when this long call spread maxes out. Like, for example, if the stock is trading, let's say the stock is trading right around where the break even is at, right here, right in this scenario, because we're going to go through a scenario with real options that kind of addresses the same setup. And if the stock's trading right around this level, well, strike A, you're long, you bought that option contract, that wants the market to go up. Strike B, well, you sold that option contract and that wants the market to go down. This is the most expensive option contract because strike A would be considered in the money, and strike B in this situation would be considered out of the money. Now, they're going to fight each other until you get to the expiration date. In particular, the time premium inside the option contract is going to fight each other the most, in that if I want this long spread to look like this, which is at the expiration date, if I want to get the maximum out of my long call spread, if I'm correct on my forecast and the stock goes above strike B, giving me the maximum profit, that's only achieved if I pay very little to buy to close my short strike B or my option contracts in that spread. So if I put this trade on, and let's make it fairly extreme and say we're looking at 90-day option contracts, and the stock's sitting here and instantly it runs up to strike B, well, I'm happy. I made money on the trade, but the fact that it moves so quickly hurts me because strike B still has 90 days to expiration, and I need to buy and close those option contracts in order to be profitable, or to make the maximum, I should say, on that trade. Now, if the stock continues beyond strike B, and let's still stay with the 90-day scenario, and all of a sudden it becomes way deep in the money, well, when that happens, time premium is going to dry up on both strike A and strike B. And it's just all about time premium. They're both of those option contracts are going to have a lot of intrinsic value in the money amount. And that would be one way that we can get the maximum out of the trade. But now, more than likely and more often than not, the stock doesn't blow through the upper strike of your long call spread and just keep on running. Most of the time, the way to get the maximum is to be somewhere around strike B or beyond, closer to the expiration date. And that has everything to do with time premium. So let's start with there. Here's the scenario. First of all, we have inside the options playbook. Remember, we were saying the stock is trading somewhere around where this break even is on our profit and loss graph on our long call spread. And we're going to go a little bit in the money and buy an option contract. A call option is the first one we're going to start with, and go a little bit out of the money and sell a option contract a little bit further out of the money. Okay, so let's back out here for a second, and we're going to use real quotes. Now, the markets are rocking and rolling, but this is a pre-recorded show. So I just want to let you know that the quotes that you're seeing will not be real time. All right. So, well, they're real time as of today, but not on the day you're watching the show. Here we go. Let's go back to the Tradier Pro. And we are in the options grid. And I specifically set up my chains to talk about long spreads, just that simply. One of the most efficient indexes out there is the S&P 500 index, and it's behaving. It's trading right around 5,805. In other words, it's very close to a strike price. Now, as far as time premium is concerned, we're going to go equidistant in and out of the money. We're going to look at a 10-point wide spread, just to make things simple. The math will be easy on a 10-point wide spread. So it's at 80 right here. The options grid is highlighting the most at the money option contract. Right here, it's 58.05. So if we go 10 points down, we'd be looking to buy the 57.95 strike here. And then we go 10. I want to go, actually, I'm sorry. 1 second. Let me clear that out. We're going to go 5 points down, and we're going to buy the 5,800, and then we're going to go 5 points up, which will give us a 10-point wide spread, and sell the 58.10. So we're straddling where the stock is at. We're going equidistant approximately in the money and equidistance approximately out of the money. Now, I'm not looking at the quote down below, but I know this is going to be trading close to $5. And here's the reason why. So the midpoint of this spread will be close to $5. It's all about time value. And if you understand this component of the option contract and how it works, you can always have a good guess as to what a spread would be trading for. And this instance, it's very simple because it's straddling the stock. That means we're going 5 points in the money. That in the money option contract will have real value. It will have intrinsic value, in the money value, but it will also have time premium. Guess what? That time premium will be equal to, or very close to equal to, what the out of the money option contract 5 points out of the money has. So that's how I know that this is going to trade somewhere close to $5. So in this instance, market came down $1, so it's kind of screwed up my numbers, but it's trading at 5.85, and it's mainly because we've gone down about $1 on this trade. So 5.85 is where we're at. If we look at the extrinsic value of this option contract, the intrinsic value is the amount that it's in the money, and the extrinsic value is the actual time value. So if we're selling the 58.10, the time value is 35.25. And if we're selling the 5,800, the time value is 37.45. The market is not, now it's not being very nice. It's dropped on us quite a bit. But that difference, notice how close the time values are between these two option contracts. And if you buy the same amount of time as you sell, well, then you're going to basically have a 50-50 chance on this spread of either making $5 or losing $5. And that's what will happen when you center your long spreads around an underlying stock, like in this instance, the S&P 500 index. And it doesn't matter if you're doing it on the call side of things or if you're doing it on the put side of things. As long as you buy as much time premium as you're selling, you're almost always going to have a 50-50 scenario where I pay $5 to try to make $5. I pay $2 to try to make $2. When you straddle the underlying stock the way that it is, you take the time premium out of the scenario. You still have to buy that short option contract back to close it out, but you're buying as much time premium as you're selling. That means that your break even is going to be very close to where the underlying index is in this instance, or the underlying stock would be at. So our break even in this scenario at 5,800, and the market once again moved against us a little bit, but 5,800 plus 585 would be 58,585. So you'd add $5.85 to 5,800, and that would be our break even. Okay, now we're a little bit in the money, like I mentioned. It's moving again, it's coming back. So that break even at 5,805 is about, if you bought the stock outright, this is about what your break even price would be at. And now we notice that we just hit that strike. Beautiful. And look at the time premium, 36.89, 36.15. Almost exact amount of time premium while we're sitting right at 58.05. That's the scenario that we're talking about. That's going to affect our break even total on this trade. And we're going to trade somewhere right around, just like if we had bought that stock outright. Now, if we flip the script and we do it on the put side of things, and we buy this option contract and we sell this option contract, we create a long put spread or a put debit spread. Now we're a little bit in the money, so we got the different scenario. But if we look at time values, once again, 52.50 is what we're buying, $4.51 of intrinsic value, 32.45 of extrinsic value or time value, and that's going to be very close to the option contract that we're selling. This is all out of the money, so it's all extrinsic value, and our break even is going to be very close to where the current underlying stock is at, or index in this case, at 85.05. So same scenario. If I'm straddling the stock, I am trying to buy as much time premium as I'm selling, and I'm going to make it all about the stock price and not about the time premium. So, for example, we have a bunch of stocks that are announcing earnings next week. And if you want to just do a simple play saying, I think JP Morgan, who announced this morning, is going to have a good announcement, and I do think that the stock will go up. I can straddle the stock. I can then make it a 50-50 play. If the market jumps up on the open, I make the maximum. If it jumps down, I lose the maximum on that trade. That's simple. Just totally flat out making an earnings play. So we have a bunch of stocks that are going to be announcing earnings next week, but one of them is Netflix, NFLX. And this show isn't about trying to get bearish or bullish on the underlying, but you can see here that today's implied volatility on the October 11th option contract is trading right around 29%, and it jumps to 71 on October 18th. That means that they're going to be announcing earnings next week. And so we're going to just look at a very simple trade around earnings in a very popular stock like Netflix. So the way that we're going to do this is we're going to use the October 18th expiration, and we are going to look at buying an in the money contract and selling an out of the money option contract. And we'll do it on the call side, and then we'll turn around and we'll look at it on the put side. It's a $700 stock. We'll go fairly wide in this instance. Let's go 20 points wide on the trade, and just try to highlight once again that if the stock is trading fairly close to a strike, if you go equidistance in the money and equidistance out of the money, you're buying just about as much time premium as you're selling. So 725, yeah, we're fairly close, not bad. And then if we go down 10 points from here, we're looking at the 715. We'll buy that option contract and we'll go 10 points up and we'll buy the 35 and we'll sell that option contract. All right, so right now the stock is at 724.44. If you take 715 and you look at the midpoint of our trade down below, let's call it 9. There we go. We'll keep it 9.70. So we take the long strike 715, we add $9.70 onto that, and we see that our break even, if we did this long spread based off of this math, looking where this profit and loss graph is, or I'm sorry, this price of the stock, which would be where we break even. If you bought 100 shares of stock, your cost basis would be 724.34, and that would also be your break even on that stock. Well, if you do this trade, long call spread, your break even would be 724.70. About 35 cents more than where this is at as the live markets tick away. Okay, so once again, you're removing the time decay situation. You're buying as much time premium as you're selling. That makes this trade close to a 50-50 bet. You're paying $9.70. I'm not going to look at this one and look at what we fixated in here. And the width of the spread is $20. So once again, very close to a 50-50 bet in that if Netflix opens up and it skyrockets above the 935 strike, well, then we make $10.30. If it opens down and goes below the 715 level, well, then we lose $9.70. Fairly close to a 50-50 scenario. And it's all about the time premium when we're looking to buy this trade. Now, you can flip the script. Let's do it real quick like. And then I want to talk a little bit about buying out of the money spreads. Okay, so if we close this up and we go the opposite way and we go on the put side of things, you'll see that we're very close to the same cost on the put side as we are on the call side. So we buy the 735 and it goes down to the 15 and we sell the 15. And now the exact opposite is true, right? We paid $9.70 hoping to make $10.30. Here we're paying $10.30, and I'll lower it just a little bit to make the math exactly the same. We're paying $10.30, and that's our max risk, and our max upside is $9.70. The exact opposite of the call side of things. And if there's efficient pricing, which Netflix will be very efficient, especially going into earnings, that is what should be the case. We're buying as far as an extrinsic value is concerned, time value, to $23 and let's call it 80 cents. Over here, you're looking at $24. 20 cents is the difference. Once again, 50-50 bet. Okay, so I don't mind if you want to play earnings, you want to look at earnings, you want to say, I think Netflix earnings is going to be good or bad. This is not a bad way to trade it because you're taking out the biggest issue with trading around earnings, dealing with time values and more specifically implied volatility. Now, let's go back and look at how I might also want to trade this. Okay, this was a fairly expensive trade to do. If I want to do 20 points, which is very feasible in Netflix, as a matter of fact, we can look at the expected move based off of today's price. All we got to do is look at if we're buying an at-the-money option contract. So in this instance, we're buying Netflix. If we bought the call and we bought the put, that would be the long straddle. The long straddle gives you an indication of what the marketplace is implying the move could be around that earnings event. Now, this is going to say by that October 18th earnings, Netflix is going to be announcing on Thursday. So they're going to be announcing on October 17th. Okay. So this is the expected move from now until this expiration date. But on a percentage basis, we're looking at 57.72 divided by 724 equals about an 8% move is feasible. But more importantly, if we're setting up a long spread, what I want to know is the total point move, which is about 57 points. Okay, so what does this mean? You hear this all the time with reporters and in articles in newspapers, or nothing's on paper anymore, but online news, financial companies, Wall Street Journal, Bloomberg, those type of things. We're looking at, a lot of times they'll call me up and say, hey, Brian, Netflix is announcing earnings. What's the expected move? And they know the answer, but they ask because they want to have it officially quoted by somebody known as an expert. And they'll come back and say, and I'll say, well, let me look at the options. The options are saying that Netflix is going to have about an 8% move, either to the upside or the downside. But that becomes, in the betting world, if you were talking about sports betting, that would be known as the over-under. If you think that Netflix will move more than anticipated, you would buy the long straddle. And if you think it would be less than anticipated, you would sell the long straddle. Just like you're looking at a football game, the two NFL teams are playing, they total the score. What do you think the total score will be? Do you think this is the number that is set? In this world, we call that the expected move. Do you think it would move? They'll score more points than that? Or do you think they'll score less points than that? And that's called the over-under. Very similar in the options trading world. Now, I don't want to buy a long straddle or sell a long straddle and play it that speculatively. But if the marketplace thinks that this stock can move 57 points, I want to do a spread and I want to be within that range. I want to take what the marketplace is expecting and I'm going to use that information to set up my spread. So we straddled the stock on the long call side of things. Let's go on out and buy a more speculative out of the money long call spread or long put spread. So on Netflix, with the stock at 725, we'd take 725 and add 50. I'm going to say 58. We'll round up to that. And that's about 783. So I do not want to sell any strikes that are above 783. Why? Well, the marketplace is saying that would be a hard move. Like it would be hard for it to move beyond 785 because that's the expected move on this underlying stock. So I want to trade somewhere in the middle here. Now, obviously, the closer to the strike, if the earnings are good in Netflix, the better off, or the closer to the strike, the better chance of it reaching that strike price. And a way that I will do this is to actually concentrate on the delta of an option contract. So let's go back in, let's change the grid format up, and let's look at delta. Okay, so in this instance, if the stock's at 725 and I have a delta over here, I'd like to target somewhere in the 30 range as the strike that I'm going to sell. Anywhere between 30 and 40 is just fine. So in this instance, we'll do 35. Okay, so we said we wanted to do a 20-point spread, which is going to be a little bit costly. We were looking at paying $10 for our spread. We're going to say, well, we're going to stay within the expected move. We're going to have a decent probability of the stock reaching our strike, and we're going to look at that. And then we're going to go and we'll do the this is 30 here. We'll do 760 to make the math really easy and look at a 20-point wide one. So here we go. We're going to buy this option contract and we're going to sell this option contract. All right. And oops. Boom, boom. There you go. So now we've taken the cost down from $10 around $10 when we straddled the stock to $7. But the difference is $3 in cost approximately, but we need the stock to go to 760 now. So we do need the stock to go up higher. So you're reducing your upfront cost. You're staying within the expected move. You're saying you got a fairly decent chance of it reaching that strike. And because of that, I'm going to pay less than if I straddled the underlying stock. But this might be a way that I would speculate a little bit more on Netflix being positive on their earnings. So the strike that we're buying is the 740 strike, and that is a 43 delta. And down here, the one that we're selling is the 760 strike, and that's about a 33 delta. Okay, so if we do this, the math is saying there's about a 40% chance that the underlying stock will finish above 740. Anywhere above that is positive. If we want to hit the break even, we got to go 740 plus 705, which would be 747.05. There you go. That's everything that I think about if I want to trade long spreads around earnings. If we want to flip the script, we can simply go around the other direction and we can look at the 43 delta on the put side of things. Okay, so let's look over here. We got deltas on this side. We'd be looking to buy this option contract, and then we go down 20 points. So then we're looking at 705, and then another 20 points would be 705, 85. No, 705 down to 10 points is here. That's 705, and then another 10 points from 705 would be 65, and then we buy here. All right. The one that we're doing, and this is the one that we're selling. And in this instance, we're going 20 points wide. We're going to be paying a little bit more for this option contract. And that's right here. We're on 43 and we're selling 32. And that is the issue here is the difference between puts and calls. Puts will trade at a little bit different volatility than call options. And this is just a real world scenario. So the market may have moved a little bit while we were doing the trade, but now we're paying a little bit more on the put side of things just because of the way that volatility works. But we're still selling the fairly close to the same probability. If we jump, let's jump down one more. I think the market moved on me a little bit while I was trying to set it up. 720, and we're going to go 20 points, 90. Okay. Now we're at 775, and we're doing the 40, and we're selling the 30. But because of the way volatility is, put the long put spread, and the long puts just in general usually will cost more than the long calls. And that is just a fact of life. That happens because stocks have a tendency to go down faster and more explosively than they have a tendency to go back up. And so because of that, puts are equidistant out of the money, usually sell for a little bit more implied volatility than the call side of things. And that's a normal occurrence. All right. Well, that's it for this edition of Options Guide TV, Options Education Options Guide TV. If you'd like to learn more about these trades, please follow me on Twitter. My handle is @BrianOverby, and we stream live Options Guide TV there. You can also check it out inside the Tradier Hub, hub.tradier.com. There you can actually ask questions if you set up a login and view the show while it's live. 11 a.m. Eastern Time every Monday, Wednesday, and Friday inside the Tradier Hub. Also on the Tradier YouTube and on x.com. Thanks for stopping in, and we'll see you soon for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.